So we all know travel is back with a vengeance, right? But what does that actually mean for the companies that keep those planes in the air? Well, today we're taking a look under the hood at SIA Engineering Company, or SIAEC, and digging into their latest financial results. We're going to see how they're riding this wave, and honestly, we'll uncover a pretty surprising secret to their success. It's not what you might think.
All right, so here's how we'll break it all down. We'll kick things off with their performance, the big numbers. Then we'll dig into where the money's coming from and where it's going. After that, we'll get to the really interesting part, the power of their partnerships. And to wrap it up, we'll look at the challenges ahead and what they're doing to stay on course.
Okay, let's jump right into it. First up, a strong half-year performance. Let's look at the headline numbers.
So the first number you really need to see is this, $83.3 million, and that's their group net profit. So after all the bills are paid, staff, materials, you name it, this is what's left. A really, really solid number for the first half of the year.
But here's what makes that number even more impressive. It represents a jump of 21.1%. I mean, think about that. That's compared to the same time last year. Growing your profits by over 20%, that's a huge deal no matter how you slice it.
And that profit was built on a really strong foundation of revenue. We're talking $729 million. That's the top line number, and it just screams that demand for their maintenance, repair, and overhaul services is absolutely booming right now.
And this chart right here really tells the story visually, doesn't it? Look at that jump. From $68.8 million last year all the way up to $83.3 million this year. That's, an extra $14.5 million in profit? It's just a crystal clear sign of how strong the recovery in aviation really is.
And you know what? They're sharing that success. The company boosted its interim dividend to 2.5 cents per share. And that's not just a nice little payout for investors. It's a statement. It's management saying, hey, we're confident, we're healthy, and we think the future looks bright.
So we've seen the big numbers, but the big question is, where did all that money actually come from? Let's decode that revenue growth. Okay, this chart gives us a great snapshot. As you can see, the huge majority, we're talking almost 70%, comes from what's called airframe and line maintenance. That's the bread and butter work, keeping the planes themselves in top shape. The other chunk, about 31%, is from the really specialized engine and component work.
So, why the big jump in revenue? Well, it's not a mystery. It's tied directly to the travel boom. More flights are being handled at Changi Airport, for one. And they're doing a lot more heavy maintenance checks. Those are the big, complicated, and very lucrative jobs. But honestly, the real kicker? They signed new service agreements with Singapore Airlines and Scoot worth around $1.3 billion. That's a massive, steady stream of work locked in.
Okay, so we've seen the money coming in, but what about the money going out? Let's flip over to the story behind their expenditures.
And no surprises here, this is a business that runs on two things, people and parts. You can see staff costs make up almost half of their spending. That makes sense, right? You need highly skilled people to do this work. Then you have material costs. Put those two together and you've got nearly 3/4 of their total expenses. Pretty typical for this industry. But here's where it gets interesting. Their total spending actually went up by 25%. Part of that is just the cost of doing more business, more materials, more people. But there were a few specific things that hit their operating profit. They had a $4 million impairment on a contract, some major IT costs that they couldn't capitalize, and some early losses from new subsidiaries just getting off the ground.
All right, now we're getting to what I think is the most fascinating part of SIA's entire financial picture. This is about the power of their partnerships. This is the real story.
Okay, just look at this. This is the whole ball game right here. The profit they made from their own day-to-day operations was $13 million. Okay, not bad. But look at the right side. Their share of profits from joint ventures and associates, $71.3 million. That is more than 5 times their own operating profit. This shows you, plain and simple, that their partnership strategy isn't just a nice-to-have. It's the absolute core of their profitability.
And these partnerships are growing like crazy, up almost 22% year over year. And if you dig in, you see that the engine and component JVs are the real heavy hitters, contributing almost all of that $71 million. So these strategic partnerships with big names in the engine world, that's where the magic and the money is really happening. They're even expanding capacity at places like SASL to keep up.
Okay, so the picture looks pretty rosy, right? But it's not all smooth sailing. Let's talk about some of the headwinds they're facing and the challenges for the whole industry.
They've been really clear about two main risks on their radar. You've got geopolitical and trade tensions, that's always a factor, but the big one, the one that affects them every single day, is the global supply chain. I mean, think about it. If they can't get a specific, critical part for an engine, that plane isn't flying. That creates huge delays and costs. It's a massive challenge.
So, facing those risks, what's the game plan? Let's get into how they're investing in future growth. This is their strategic response.
They've laid out a really clear three-part strategy. First, they're expanding their footprint across the Asia-Pacific region. Second, they're beefing up their capacity and capabilities for the future. And third, they're focused on enhancing their core services and just making their operations stronger and more efficient.
And this isn't just talk. They're already on the move. They're partnering with Air India to tap into that huge market in Bangalore. They've got an investment agreement in China. They're already up and running in Cambodia. And they're not stopping there. New stations are planned for Indonesia and Japan. They are planting flags all over the region.
This next part is all about future-proofing the business. I mean, aircraft technology is always evolving, right? So they're investing heavily to stay ahead. They're now the first authorized service center in Asia-Pacific for Embraer's new E-Jets E2. And they've expanded their capabilities for the new CFM LEAP engines. You know, the ones on all the newest planes. They're making sure they can service the fleet of tomorrow, not just today.
And finally, they're looking inward. They're upgrading their own systems to become more efficient. They're rolling out a whole new enterprise operating system, bringing in digital tools, and they're really leaning into artificial intelligence. Get this, they've already identified over 100 different ways to use AI in their business. This is all about working smarter, not just harder. So that leaves us with the big question, doesn't it? The demand for what they do is absolutely soaring, and their strategy, I mean, it seems solid, right? Expand, get new tech, become more efficient. But can they pull it all off while navigating the mess of a truly fragile global supply chain? That's the real test. The opportunity is huge, but so are the challenges.